All right, well, thanks. My name is Gregg Ibendahl. I'm an extension farm management specialist here at K-State, and I kind of dabble work looking at the oil and gas market as well as looking at what's happening in the fertilizer side. So both those things, the oil and gas update, there should be an article on agmanager.info for that, and I did a fertilizer one update about 2 or 3 weeks ago. So if you want to see my forecast in a little more detail than what I'm going to cover today, you can go to agmanager.info and find those. I try to update those, probably 3 or 4 times during the course of the year. But today I'll talk about the oil and diesel situation and really what we can expect happening in 2024. I'll be using a lot of data from the EIA, the Energy Information Administration, and what they have for prices and supplies and such, and kind of my thoughts about where these markets are going to go. All right, well, let's first talk about diesel fuel and what's been happening there. So, this is a graph of the highway diesel prices basically since 2008, both in the nominal and real terms, adjusting for inflation. So, you can see prices tend to be fairly volatile during the course of any given year. We're certainly well below what happened at the start of the Russian-Ukraine war 2 years ago when oil prices got up to about $135 per barrel. Oil prices have really backed off accordingly, probably more than I thought they would have ever backed off. But even so, within the last year, even though the traders really haven't, I don't think have fully priced in some of the negative consequences of the war, prices were fairly stable in a 70 to $80 range. But even last year, they declined by about 75 cents and they rose by about the same amount, and they came back down again. So, that's typical kind of the volatility that we see here. So prices, well, they may seem high now. There has certainly been times in the recent past where they have been higher. Now, the question going into this year is, are we going to still kind of see this drop down and then the rise back up after June and back down again? That remains to be seen. Saying all this, I think world supply is still a concern, especially if Russia, they're the second biggest exporter of oil in the world here, if that is disrupted at all. And then the domestic refinery capacity is still, we've never bounced back fully from what it was pre-COVID. So, during COVID, quite a bit of the world oil production shut down. That happened in the US too. And then we had some refineries actually go out of business and weren't rebuilt. And building a new refinery in the US is almost impossible. So getting refinery capacity increase is kind of a long, hard slow. You'll see when I get to my talk about refinery capacity, we have bumped up a little bit, but without the ability to build a new refinery from scratch, it's going to be a long, hard road to get those back up there. So again, with these prices you're seeing here, this kind of reflects the 70 to $80 oil price range that we're currently seeing now here. So as long as oil prices stay in the current range, I don't think there's going to be a whole lot of movement in the highway diesel prices. Well, just compare what's the diesel price for compared to the last 5 years. So this blue bar is what the diesel prices were last year. The green bar is kind of where we are in the current year, and this gray area, this represents the standard deviation of prices for the last 5 years here. You can see this any given year when you combine 5 years, there is quite a range here. Last year we were kind of at the top end of that. And right now we're kind of starting a little bit lower than what we were last year. Remains to be seen if we will actually stay that way all the way through 2004 or not. Part of the reason why diesel prices tend to be higher than gas prices is this idea of diesel stocks. So again, this gray area is the 5 year kind of standard deviation range. The blue area is what was last year, and here's where we are coming into 2024. You can see last year we were well below what we typically would be. We were at the very bottom of this 5 year range. In a lot of cases, we were actually below that here. So this contributed a lot to the fact that you saw diesel prices quite a bit higher than what the gas price was. And like we go back about 10 years ago, it's fairly common for diesel prices to be maybe 30 or 40 cents higher than the gasoline prices. But the last few years, it has been well above that here. So again, a lot of this we can trace back to the situation with the refinery capacity and their ability to actually make diesel and gasoline. If you compare that to my gasoline stock, I just noticed as I switch slides here, I think I may have the wrong, I think I may have repeated the diesel side here, but the gasoline stocks are still pretty low too. So even though this may be a repeat of the gas side, gasoline stocks are as low as well here. So what we have is we have refineries that kind of face a conundrum of what should we do with producing diesel fuel and gasoline. Now, refineries have a little bit of capability to adjust the mix they produce. Now, you can't produce all gasoline from a barrel of oil, and you can't produce all diesel fuel from a barrel of oil, but they can adjust that to some degree. If you look at the EIA website, even they don't really know exactly how much flexibility there is there, but they do say there is some. So my hypothesis is that there's a lot more consumers who drive gas cars than there are construction and farmers who and truckers who use diesel fuel. So they're going to kind of cater to the many voices being heard there, and they're going to probably emphasize producing gasoline to get those stocks back up before they work on maybe on the diesel fuel side. The result is that you see kind of a big premium now, and in the last few years of diesel fuel over the gasoline price. And again, here's what happened during the past year. You'll do notice here that at one point during the year, this gap between the gasoline and diesel prices closed quite a bit, which was kind of surprising to me. I'm not looking at back some of the historical data and some of the news, and I'm not sure what exactly happened for this to occur where the gap was actually pretty small. But then it kind of went back to what we've seen over the last couple of years where this gap has widened, and we're probably looking at, probably 50 cents to a 75-cent gap, which is what we have seen over the past couple of years. So the question going into 2024 is this gap going to go away for during the first half of the years like we saw last year, or is it going to stay more in the consistent range of 50 to 60 to 75 cents like we have seen over the last couple of years or not here? So that's kind of the big question going forward. And just looking at this diesel price premium over the last several years here, you can see when it's in the $1.20 range, this is well where it historically has been when you look at maybe 10 or 20 years worth of data, which is typically to be down here. But we did get to this point here where it actually was below average. And then again, it has gotten the range we have typically has seen over the last couple of years. I have a graph that kind of shows the typical 5-year range here in gray, like some Brazilian graphs. Here's the situation last year. This gap really went away really quick. And in fact, we got to a point where we were really below what historically had been. But again, the gap increased again. Now we're probably more at the top end of the range. Looking at the first few weeks into this year, you can see we're still above what the 5-year range has been, but again, we're still a little bit lower than what it has been. So in my forecast for the diesel fuel price, I'm kind of taking this last year's drop in this price premium into account and saying, well, using the past as a recent guide, I think maybe we can expect diesel fuel prices to go down because maybe we can close that gap back up again. But it wouldn't surprise me even if we do close it back down, if that premium actually goes back up in the future toward the end of the year. All right, let's switch over and talking about oil because again, oil is the biggest driver of what happens with the diesel fuel price. And if you've ever looked at the oil market, futures market, there is a fairly robust market out there, but really there's not much information in that futures market as far as what I can tell here, because if you look at the furthest they price oil ahead, they don't really have much variation at all. They basically have taken the prices over the last several months and they're projecting that forward for like the next couple of years at the same price range. I don't think they're really fully accounting for some of the risk factors that could be involved in a worst case situation in Russia where their oil production was actually damaged here. But if we go back further, oil prices kind of reached their peak right at the start of the Ukraine war. During that first couple of weeks here, oil got up to over $130 per barrel here, where traders really weren't sure what was going to happen here. So they probably went too much to the extreme and probably overpriced the risk at this point. But really, since then, prices have come down quite a bit here. And we are now in the $70.80 range for the past year or so. And this was really the level that we saw even pre-Russia-Ukraine war here. So to me, traders really aren't pricing much of a risk factor in there at all here if they're willing to price oil at pretty much the same price that it was pre-war here. So the question is this price too low? I would say it probably my personal opinion is this is really probably too low because there could be some bad situations where something would happen, and that's the case here. I don't think they have fully incorporated that into the price. I can't see much downside possibilities with oil prices going much below 70. I mean, if we had another COVID event where, demand was basically shut off, that might be a possibility. But to me, the upside risk is a lot greater than what the potential downside possibilities are here. So again, my personal opinion is there's not quite fully the price premium there should be in this if I was an oil trader. Again, I don't trade oil, so they're not asking me for this kind of stuff. All right, so where does our oil come from? So here's the information I took from the EIA. This is from the short-term energy outlook. This is broader than oil. This is oil and other liquid fuel supplies by production area. So this is really, I'm going to show you another graph here in a few minutes that's going to show you the kind of the net gain or loss from production versus consumption. But this is just a production side. So you can see Russia down here is one of our major oil producers. They're also one of our major exporters as well. We kind of have this other area right here, kind of the hodgepodge of leftover categories. Here's OPEC right here. Again, they're our biggest producer and also our biggest exporter when you factor all the oil, OPEC countries together. And then this area right here is the OECD countries, which would include the US, the Organization for Economic Cooperation and Development, and it includes most of Europe as well here. So, again, this group, especially when you count the U.S. into this group produces a lot of oil, but they also use a lot of oil. And I'll show you here in a second, this group is actually oil production on the negative side of things. So they're having to actually import oil to account for, even though they produce a lot, they're also using even more. Notice here, China here is at the very top. So China is certainly a big user of oil, but they actually are kind of a oil poor country. They don't really produce a whole lot relative to the amount of oil that they need here. So they're always looking out for places they can import oil because of this really low production compared to some of the other areas. And then if we combine the net liquid fuel gain, when you look at the production versus the consumption, you can see what's happening in the world here. So here is the OECD countries, which is US, and you can see that, again, the US would probably be, when you figure things beyond oil, we're probably fairly neutral as far as our liquid fuel use and consumption. But it's the European countries that are driving this deficit you see here to the tune of about 10 million barrels per day. And you can see China, again, as their economy grows and they do more things, their need for oil has gotten to be quite large here. They are needing probably close to about 12 million barrels of oil per day from places outside their own country here. Well, notice here who's the other country up here at the very top. This is Russia here. So there's the biggest producer. They are also the second biggest oil exporter in the world here. They are continuing to produce about 7 million barrels of oil a day that they're able to export here. And even though you can see the drop here during COVID, um, their oil production really hasn't tailed off at all here. So despite the threat of sanctions and the sanctions that we have imposed here, Russia is still able to get oil out. And it goes back to economic theory that really sanctions on a fungible commodity like oil really don't do a whole lot of good because they're going to find ways around those things. Russia has been shipping a lot of oil to India. In fact, I think I read something the other day that India is actually buying about 13 times the amount of oil that from Russia that they normally buy. And then China has also been a big buyer. And that's really shouldn't be surprising because Russia and China share a border 2,600-mile long, although it's clear over on the eastern side. That's the sixth longest international border here. So, we can do sanctions all we want here, but to me, one thing the sanctions may have done is they have kind of forced Russia and China into a partnership that may not have existed outside of us imposing sanctions on Russia here because China obviously needs a lot of oil. Russia has oil. They share a border here. So, Russia will ship China oil, and China will ship Russia either money, or they could also do some technology as well here. So, despite our best efforts to slow Russia down here, sanctions just really aren't going to work too well with something like oil. Going back to the U.S. and talking about again, this is just oil only. This is not the total liquid fuel here. You can see what's happening in our country as far as production in the blue. We have the net imports in kind of this pinkish red color. And then this very top line you see right here, this is really our total use here. So when you add up production, net imports, you get total use here. So despite the fact that we are really kind of energy independent when you factor all sources of energy together, when the crude oil side, we are still having to import oil. Now, we're also an oil exporter, which may seem strange to some people, but really a barrel of oil is not a barrel of oil for every type of oil there is out there. So the U.S. refinery system is really set up to handle heavyweight oils. That was one of probably the main justifications for the Keystone Pipeline was that was a heavyweight oil. That's what our refineries are set up for. The oil that we get from fracking is lighter weight oil. I mean, we can do that, but other countries are better set up to do lighter weight oils. So we tended to export our lighter weight oils. We import more heavier weight oils, but we're still a little bit short from that. A lot of this has to do with the refinery capacity and the fact that even if we were producing all the oil that we needed, we just don't have the capacity to actually refine it all very well. And you can see what happened here during the fracking side. So this was a point we got where fracking kind of started. That really helped out our domestic situation with oil. We became a lot less dependent upon foreign oil sources. When you look at the percent of oil imported, we're down to probably the 30% range or so. Whereas you look at, pre-fracking, we were probably close to 65 or 70%. So fracking really, as far as being less reliant on overseas oil, fracking has really helped there. So again, with our refinery capacity, I don't know if we're ever going to get this much lower here. One thing that could be, I don't know if people are really considered though, is this kind of this forced move to EVs, electric vehicles. That actually probably somewhere down the road will get to the point that will reduce our demand for gasoline here, and that may really help us out for the refinery situation. Even though at the current time, I would argue that we could probably use more refineries here in the U.S. or bigger refineries at the very least. So again, here's looking at the refinery situation and the utilization. Here's where we were pre-COVID. We had this many amount of barrels we could do per day. Thanks to COVID, that really dropped off demand and use. So we had some refineries close. A lot of those closed permanently and will never ever come back. The environmental situation in the U.S., no matter who the president is, really is not going to allow really a new U.S. refinery to be built. We can modernize and maybe expand our current one. So we have built this back up a little bit, but I don't really think we're ever going to get to the point we were back here, at least not for a long, long time. So keep that in mind as a limiting factor in our oil and diesel and gas production here in the U.S. But notice here, even though our refineries are really old, the last new refinery in the U.S. was built probably 50 years ago, we are getting really good use out of those things. Typically, we're at 90% or above, which is a good thing. When it probably drops below 90, we start to see some price spikes. And here's what happened during COVID. No one was driving. We were, all forced to stay home here. So we didn't really run our refineries too much there either. That's why you see these low spots right in here. What's my predictions going forward? Here's a graph in the EIA, what their prediction is for oil prices. You can see they have their prediction in blue, and then you see they have in green is New York Futures Exchange. It's pretty much they're spot on there here. And that's why I don't really think the futures market is a good guide. It doesn't really provide us any information about what may happen in the future here because they're just taking the current price and maybe having a very slow trend downward. And then you can see their confidence intervals. I would argue that their confidence interval on the low side is way, way too low here. I really can't see oil ever getting down to the $50 range unless we have another COVID-like event here. So if I was doing this forecast, I would put the low end range well above this, probably maybe around the $60 range. And I'm not sure their top end is really incorporating all the potential risk out there either here. So we've already been close to 140 during the start of the Russia and Ukraine war right here. And they're saying that's their top end here. I would argue the top end should be higher than this and the bottom range should be higher than what it is here. But again, that's from the EIA and what their forecast is. So, if we look at oil prices and we extract what the and run a regression for what the gasoline and diesel price is, that works out to be a really nice regression because oil prices are definitely a predictor of what gas and diesel prices are. This correlation fit, regression fit is probably close to 90% or higher here. So it's probably a little higher for the gas side than it is for the diesel side because you see some points here that the graph is really not fitting, but this is more of a recent phenomenon, these kind of points that are above what you see with this typical trend line. This kind of reflects our refinery situation in the U.S. But if we have $80 oil, which is we're not too far from that right at the moment here, that would really translate to about 340 gas and 385 for diesel. Again, that's a highway diesel price and a farm diesel price. These curves have shifted more so with the diesel side than the gas side. I would argue that the gasoline side hasn't changed much. The diesel side has gotten steeper to reflect some of those higher premiums that we're seeing now here. So, but again, this is a pretty good guide for what may happen in the future as far as diesel prices are concerned. So here's my prediction for the Next 12 months, I would argue that if we look at the current state of what the futures market is saying for oil prices, which is in this mid $70 range, and I factor in the fact that diesel gas premium may go down, I'm basically saying that the highway diesel price is probably going to go down from 385 to maybe like 330 or so, somewhere around there. Possibly if that same trend holds last year, but again, prices could rise back down. So overall, over the course of the year, I guess I'm seeing the same slow decline in diesel prices like the EIA is saying. But again, that's all dependent upon oil prices staying in the $70 range, which would say, is Russia still producing and exporting the same amount of oil they are now here? As long as that holds true, yeah, this is going to hold true. But if something should happen in Russia that they can't get oil out, then very likely we could see a big spike in this here. But again, I'm having to use the futures market for the my forecast for oil prices. I don't really have a better forecast than the past, and I think they're doing the same thing with their forecast. Let's talk a little bit about maybe ways farmer can potentially save when they're buying diesel fuel. So there is a little bit of seasonality in the diesel fuel prices when you basically look at the price in a given month relative to the average price for the whole year. You do see a little bit of times when diesel fuel is higher relative to other points of the year. Typically, right now, um, diesel fuel prices tend to be highest in October and November, which is really bad for farmers because we use a lot of diesel fuel on farms during harvest season and wheat planting season during this time frame. And if you're buying on an as-needed basis, you're probably paying higher than the average yearly price if you buy in these 2 months here. Whereas there's a little bit of a price spike here in the spring too, but really what it has been fairly consistently is January and February tend to be the best months to buy diesel fuel, although you see a lot of variation in that. But really, if I was a farmer and I had the capability to store fuel, I think I would really consider buying diesel fuel now here because historically, based on the last several years, February tends to be the cheapest month on average for buying diesel fuel. Now, when we look at this on the gas side, gas exhibits strong seasonality, and it's been this way for years and years, is that we see the lowest price for gasoline during the winter months, January and February, but by far and away, the highest prices are in the summer here, and that's really to be expected because most Americans do some traveling during the summer here. So our demand for gasoline goes up in the summertime, and that's reflected in the price you see. So it's a little bit higher than what it typically is during the year here. Typically, Memorial Day is the start of when they start to go up. And it'll stay that way through Labor Day when school starts and people stay home more. But the summer months is the worst time to buy gasoline. All right, let's look at some specific situations here in Russia, just to see where Russia kind of stacks up with everyone else here. So these the blue ones are the OPEC countries. These kind of yellowish countries are kind of the plus countries that they sometimes work together to control the oil supply as much as they can. Again, cartels really don't work too well either on the oil side of things. But you can see what a big player is Russia is compared to everybody else here. So Russia produces about 10 million barrels of oil a day. They use about 3 million, which leaves them about 7 to 7.5 for exports. So Saudi Arabia is just slightly bigger here, so that makes them the biggest player. But again, Russia is a major player in the oil market here. So what happens with Russian oil production is going to have a big impact on oil prices here in the U.S., even though we aren't directly importing from them. But again, oil being a fungible commodity, we can't ignore what happens on the world markets. I'll give you an idea of where the map of Russia oil and gas production is here. You can see the areas in yellow are producing regions, and these areas in green are the prospective regions. So again, it looks to me like a lot of the Russian oil production is probably away from areas of the war areas. So I can't really see a whole lot of potential for this to be disrupted a whole lot. Now maybe some of the export terminals here, but as I mentioned, this border here with China and the fact that they could also probably get oil across these other two countries, Mongolia and what is it, Kazakhstan through here. Yeah, so they could I think they could easily get oil to China, which obviously is a big has a big need for oil that probably Russia could probably take care of a lot of that if they only got their oil just from Russia. Um, so talk a little bit about tariffs here. So I just saw this headline last week, and this talks about a CNN article talks about how Russia has never been richer thanks to U.S. strategic partner. This is from CNN, so I'm not sure this would necessarily is Well, you take it for what you will. This is the mainstream outlet or not here. But th this is what a lot of the least popular press is saying about the tariffs and what we're trying to do to stop Russian oil. Again, my opinion of looking at most mainstream media is that they're kind of clueless when it comes to this kind of thing. Or they do not understand this idea of oil being a fungible commodity here. So that makes tariffs hard to work here. And this article goes on to explain how Russia is selling a lot of oil to India. India is turning around and refining it and sending a lot of the byproducts back to the U.S. here, and how the U.S. is in effect indirectly buying Russian oil and how this Russia has this kind of this shadow fleet set up here. I would what they're saying is not really wrong, but their analysis kind of implies that well, if they could just put a clamp on India and what they're doing here and get rid of the shadow fleets here, could be actually hurt by sanctions. That's not going to be the case. Even if we were able to shut off Russia oil from India and shipping back to the U.S., there's going to be another way around that for Russia here. So even though we may impose the tariffs, uh, it's not going to work. That's just what economic theory would say here, and we're seeing it play out before our very eyes at the moment. All right, I just want to say a few minutes about bio and renewable diesel because I think this is a bright spot as far as maybe for farmers especially because this is a non-fossil fuel type fuel here. We are using soybean oil and um, leftover vegetable oils and refining those into diesel fuel. There's really two types here, the biodiesel and the renewable diesel. I'm looking at an article right now for Ag Manager kind of explaining the differences here. The biodiesel tends to be made from like things like soybean oil. It's typically blended into a type of a blend. As you can see here from the EIA prediction here, that market looks to be maybe capping out, and long term it's probably going to even go lower than this here. But the real potential is the renewable diesel, where we take used vegetable oil and we actually produce a diesel fuel from this renewable and old vegetable oils that's really chemically identical to diesel fuel. At least that's what they say it is. I haven't talked to too many farmers who actually use this, but it's supposed to be the same as regular diesel fuel that we get from under the ground here. I think this has a strong potential here. You can see what they're estimating for growth, at least the EIA is considering here. They have basically a 3-year forecast here, but they see tremendous growth in this. In fact, if you look at this as a percent of the total diesel consumption market, they're saying in about 2 or 3 years here, this renewable biodiesel could actually be 12% of our total diesel use, which would be a great thing for farmers. If we could actually make this work, and assuming it doesn't cause any damage to diesel engines here, the fact that we can depend upon oils we've already used for something else that we don't have to get out of the ground, I think this could be a really good thing for farmers and truckers in the U.S. All right, so questions and comments. Again, most of my things can be found on Ag Manager, especially my write-ups on the fuel and the fertilizer side.
Question, any thoughts on the sustainable aviation fuel market development potential? Is this something reliable for farmers to consider?
I haven't really looked at the sustainable aviation side thing. I'm just now starting to look into the biodiesel and renewable diesel to some extent here. The EIA does have some information, but again, these are fairly new markets here, so a lot of this is remaining to be playing out here. But I'm cautiously optimistic. I think all these things could be good things for farmers.